Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Procter Gamble was founded in 1837 by William Procter and James Gamble. Their headquarters are in Cincinnati, Ohio. Procter Gamble specializes in personal healthcare and hygiene products. Some of the notable brands that they own include Pampers, Bounty, Tide, Dawn, and Febreeze. Procter & Gamble's operating segments include beauty, grooming, healthcare, fabric and home care, and baby, family, and feminine care. In 2019, the company's most profitable segment was fabric and home care, which was responsible for 29% of their net earnings. Procter & Gamble's healthcare segment has been growing the quickest for the company, with a 13% increase in sales between 2018 and 2019. Procter & Gamble is currently the 11th largest company in America, valued at $284 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Procter & Gamble stock earned $4.01 per share. In 2015, this number dropped by 39%, down to $2.44 per share. In 2016, Procter & Gamble earned $3.69 per share, a 51% increase from the previous year. In 2017, they earned $5.59 per share, which was also a 51% increase from the previous year. In 2018, Procter & Gamble earned $3.67 per share, which was a 52% drop from 2017. And in 2019, Procter & Gamble earned $1.43 per share, which was a 157% drop from the previous year. This data indicates that Procter & Gamble's earnings have decreased on average 19% per year for the past 5 years. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of May 12, 2020, Procter & Gamble was trading at $114.55 per share. This represents a trailing 12-month price-to-earnings ratio of 60.7. This is much higher than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of the recording was 20.6. I would, however, be careful about this 60.7 number, as I do know that Procter & Gamble is projected to earn significantly higher earnings than they did in 2019, and this should take their price-to-earnings ratio a little closer to 20 or 30. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of May 12, 2020, Procter Gamble was trading at $114.55 per share. This represents a trailing 12-month price-to-earnings growth ratio of 3.25. This indicates that Procter Gamble may be overvalued if you use this metric solely to evaluate Procter Gamble stock. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of May 12, 2020, Procter Gamble currently offers a dividend yield of 2.76% as they pay 79 cents per share per quarter. Procter Gamble most recently raised their dividend in April of 2020 when they increased it from 74 cents per share per quarter to the levels that it's at now. Procter & Gamble over the past 5 years has increased their dividend by an average of 4.2% per year. Procter & Gamble's dividend payout ratio is currently 65%. It should also be noted that Procter & Gamble has paid dividends every year since 1891, and they have increased their dividend at least once a year for the past 63 consecutive years. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt-to-equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of March 2020, Procter & Gamble had a book value per share of $17.08. This represents a price-to-book ratio of 6.7. And as of March 2020, Procter & Gamble had a debt-to-equity ratio of 0.52. This number is on the lower end for Standard & Poor's 500 companies and really indicates that Procter & Gamble does not have a whole lot of debt. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Procter & Gamble stock on May 1st of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 13.5%. If you had bought Procter & Gamble stock on May 1st of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 11.5%. And And if you had bought Procter & Gamble stock 10 years ago on May 1st of 2010, held it for all of those 10 years and reinvested all the dividends you received, you would have seen an average annual return of 9.9%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Procter & Gamble an A. Procter & Gamble is one of the first stocks I think of when I think of good stocks to hold during a recession. The products that they sell, people tend to buy regardless of where we're at in the economic cycle. People are always going to need household, healthcare, and hygiene products. And I think even during a recession, Procter & Gamble would hold up well as a company. As a growth investment, I gave Procter & Gamble a C+. Over the past couple of years, their earnings have been kind of weak and have been decreasing quite a bit. However, their projections for 2020 and 2021 are pretty good, so I'm not too terribly worried about how the company's doing. However, I'm not that thrilled about their growth prospects in the future. The next thing I'm going to talk about is Procter & Gamble's value at their current price. Currently, I think that they are about fairly priced, and I would give their value a B. I don't necessarily think that you're going to hit a home run by buying Procter & Gamble at this price, but I also don't think it'd be something that you regret. As an overall investment, I gave Procter & Gamble a B. I really like that they've grown their dividend every year for the past 63 years. I think that's a really good sign, and I think they're going to continue to do that here in the future. Like I mentioned earlier, I don't think you're going to see any crazy gains from owning Procter & Gamble, but I do think it is a good long-term buy. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching, and take care.